Picture this. You are driving down a highway at 200 kilometers per hour, and suddenly your speedometer drops to 0. The car is still moving, the engine is still roaring, but the gauge is dead. That is exactly what is happening to the silver price on this Tuesday morning, February 17th. Look at the chart in front of you, $75.56, a number that likely caused some of you to lose sleep last night. But let me be brutally honest with you. That price is a visual hallucination. It is like seeing a massive discount sign at a supermarket, but when you run inside, the shelves are completely empty. Why can I say this with such certainty? Because today, and for this entire week, the only referee of the physical market, the Shanghai Gold Exchange, is officially closed for the holidays. When the adults leave the room, the children, the Western trading algorithms, start breaking the furniture. We are in a referee-free week, a power vacuum where the price on your screen has completely detached from the reality in the vaults. I need you right now to put down the calculator. Stop multiplying your paper losses. Close your price tracking applications, because we are about to go inside the vaults, where the real numbers are bleeding out, not the red and green flashing lights outside. Where are you watching this madness from? Are you on a sunny beach or hiding in your office? Sound off in the comments below so I know we are not alone. Let us pull out the scalpel and perform an autopsy on what just happened to your portfolio. When you look at a red candle that drags the price of silver down to $75.56, your human brain tries to find a human reason. You ask yourself, who is selling? Is it a mine in Mexico dumping supply? Is it a billionaire liquidating his vault to buy a yacht? Is it a panic in the industrial sector? The answer is no. It is none of those things. If you look closely at the timestamps of the crash, specifically the microstructure of the trades that executed on Monday morning and the precursor event that happened last Thursday, you will see something that does not breathe oxygen. You will see the cold, binary fingerprint of a high-frequency trading algorithm. We need to talk about the concept of a liquidity vacuum. Imagine a room filled with people. Usually, this room is the global silver market. On one side, you have the massive buying power of the East, specifically the Shanghai Gold Exchange. On the other side, you have the paper speculators of the West, the COMEX, and the London Bullion Market Association. When both sides are present, the room is crowded. If someone wants to sell, there is someone to buy. The price remains stable because the liquidity is deep. But right now, half of the room has left the building. The Shanghai Gold Exchange is closed for the Lunar New Year. The physical buyers, the adults in the room who actually take delivery of the metal to build solar panels and missiles, are on holiday. They are not at their desks. They are not hitting the buy button. This creates a vacuum. The liquidity in the market right now is paper thin. It is fragile. And this is exactly when the predators come out to hunt. The crash you saw at $75 was not a valuation adjustment. It was a liquidity cascade. Here is how the machine works. The algorithms used by the bullion banks are designed to sniff out weakness. They know that without the Asian bid to support the floor, the price is vulnerable. So, they initiate a small sell order, a relatively tiny push. In a normal market, this push would be absorbed. But in this holiday vacuum, that small push causes the price to slip. And here is the trap. As the price slips, it hits the stop-loss orders of retail traders. These are the automatic sell orders that you, the individual investor, placed to protect yourself. But when your stop-loss is triggered, it becomes a market sell order. So the algorithm pushes the price down, triggers your sell order, which pushes the price down further, which triggers the next person's sell order. It is a domino effect. It is a chain reaction of selling that feeds on itself. We saw a preview of this last Thursday. We saw silver drop 10% in 10 minutes. Think about the absurdity of that statement. 10% of the value of a strategic global asset gone in 600 seconds. Do you honestly believe that human beings around the world simultaneously decided that silver was worth 10% less in a 10-minute window? Of course not. That was a machine reading a line of code. That was a recursive loop of selling that had zero connection to the physical reality of supply and demand. But here is where the story gets interesting. Here is where we separate the noise from the signal. While the price on your screen is flashing red, shouting at you that silver is unwanted, the vaults are telling a completely different story. We have been tracking the eligible and registered inventories at the COMEX. This is the only data point that matters. Registered silver is the metal that is actually available for delivery. It is the inventory that backs the paper contracts. In the last few days, while the price was crashing, the registered inventory at the COMEX did not go up. It went down? Let me repeat that, because it defies the basic laws of economics. Usually, when the price crashes, inventory floods the market because people are selling. But right now, the price is crashing, and the inventory is disappearing. The registered category has dropped from 98 million ounces to 92 million ounces in a blink of an eye. Millions of ounces are vanishing from the ledger at the exact same moment the price is telling you the metal is worthless. This is the divergence. This is the smoking gun. If you extrapolate this bleed rate, if you look at the speed at which metal is leaving the registered vaults, we are looking at a mathematical zero in approximately 30 days. So, ask yourself this question. If you are a bullion bank, like J.P., Morgan or Wells Fargo, and you know the vaults are emptying out, and you know that China is about to return from holiday with a massive appetite for physical metal, what do? Do you let the price drift up? No. You smash it down. You use the holiday vacuum to terrorize the paper holders. You trigger the stop losses. You force the weak hands to sell their contracts. And then, in the dark pools, off the public exchanges, you scoop up that liquidity. You take the other side of the trade. This drop to $75.56 is not a warning. It is a clearance sale for the banks. They are shaking the tree to see what falls out before the harvest season begins next week. The algorithm is not broken. The algorithm is doing exactly what it was programmed to do. It is transferring wealth from the impatient to the strategic. It is transferring silver from your account to theirs. Now, we are going to leave the noisy trading floor and walk down into the silence of the vault. This is where the truth lives. The price on your screen is just a billboard. The vault is the warehouse. And right now, the warehouse is being looted. There is a concept in criminal forensics called inconsistent behavior. If a store owner claims his business is failing and nobody wants his products, but every night you see trucks quietly driving away with all his inventory, you know he is lying. You know something else is going on? This is exactly the situation with silver right now. According to the chart we just looked at, the one showing silver at $75.56, the market is telling you that nobody wants this metal. The price is dropping. The sentiment is terrible. The algorithms are screaming sell. But let us look at the COMEX registered inventory. This is the pile of silver bars that are supposedly unwanted. In just the last few trading sessions, while the price was being smashed down by the paper market, the physical inventory in the registered category dropped from 98 million ounces to 92 million ounces. That is a massive amount of physical metal leaving the system in a matter of days. Think about the logic of that for a second. If the price is crashing because there is no demand, then the inventory should be piling up. The warehouses should be overflowing with unwanted silver. That is how a normal market works. When nobody buys, the stock rises. But we are seeing the exact opposite. The price is crashing, and the stock is disappearing. This is what we call a divergence. It is a glitch in the matrix. It tells you that the people selling the paper contracts on the screen are not the same people taking the physical bars out of the vault. And this bleed is not stopping. If you do the simple math, if you take the current rate of withdrawal, 6 million ounces in a week, and you project that forward against a remaining pile of 92 million ounces, you realize that the COMEX is mathematically on a trajectory to hit zero in roughly 15 weeks. Now, obviously, it will not go to absolute zero. The system will break before that happens. The premiums will skyrocket, and cash settlements will be forced on contract holders long before the last bar leaves the building. But the trend is undeniable. The vault is bleeding out. So, why is this happening right now? Why is there such a disconnect between the paper price and the physical reality? It brings us back to the referee I mentioned in the beginning, the Shanghai Gold Exchange. You have to understand the geopolitical dynamic of the silver market. For the last few years, the pricing power has been slowly shifting from the west to the east. The west, represented by London and New York, trades paper derivatives. They trade promises of silver. The east, represented by Shanghai and the BRICS nations, trades physical metal. They want the actual kilobars. Usually, Shanghai acts as a floor. If the price in New York drops too low, arbitrage traders buy the cheap paper in the west and take delivery to sell it for a higher price in the east. This mechanism keeps the Western banks honest. It stops them from smashing the price to zero because they would lose all their physical metal to China. But right now, the Shanghai Gold Exchange is closed. It is the Lunar New Year. The arbitrage window is nailed shut. The entire conduit that moves metal from the cheap Western markets to the hungry Eastern markets is paused until February 23rd. The Western banks know this. They know that for 1 week, and 1 week only, they can smash the paper price without worrying about a massive fleet of ships from China buying up every ounce of cheap silver. They have a free pass. They have a hall pass to manipulate the psychological sentiment of the market without the physical consequences that usually follow. This is why we are seeing this algo tantrum right now. It is a tactical operation. It is not an accident. And who is benefiting from this? Let us look at the reports coming out of the major banks themselves. You would think, given the price action, that the banks are bearish. You would think they are predicting a crash. But then you read the report from Wells Fargo that just dropped. They are not predicting a crash. They are predicting a supercycle. They just raised their target for gold to $3,000, and in a bullish scenario, up to $6,300. If gold goes to $6,300, do you have any idea where silver goes? Even at a conservative gold to silver ratio, you are looking at triple-digit silver. You are looking at a price that makes $75 look like a rounding error. So, here is the crime scene photo. On one hand, you have the banks telling their wealthy clients that precious metals are going to the moon in 2026. They are forecasting prices that imply a total collapse of the fiat currency system. On the other hand, right here, right now, in the middle of a holiday week where volume is thin and the referee is absent, they are allowing their algorithms to smash the price and trigger your stop losses. They are scaring you out of your position at $75 so they can sell it back to you at $150. This is not a conspiracy theory. This is a business model. It is the transfer of assets from the weak hands who watch the daily ticker to the strong hands who watch the decade-long trend. The bleeding vault at the COMEX is the only truth you need to know. The metal is leaving. The price is a lie. And the people who control the price are the ones buying the metal. Now, let us step away from the financial casinos entirely. Let us step away from the flashing screens, the high-frequency trading algorithms, and the manipulated paper contracts. Let us step into the real world, the world of physics, the world of manufacturing, the world where things actually have to work. In this world, the price of silver being $75.56 is not just wrong, it is irrelevant. You see, there is a fundamental law of the universe that the bankers on Wall Street cannot rewrite with their derivatives. It is the periodic table of elements. Silver is element 47. It is the single most conductive metal known to man. It is the most reflective. It is the most thermal conductive. You cannot print it. You cannot hack it. You cannot replace it with a line of code. And right now, the industrial world is screaming for it. Let us look at the solar industry. We are in the year 2026. The global push for renewable energy is not a political slogan anymore. It is a survival mechanism for nations. We are installing over 665 gigawatts of solar capacity this year alone. Do you know what every single one of those solar panels requires? Silver paste. The engineers building these panels do not care if the COMEX price is $75 or $175. They have orders to fill. They have government mandates to meet. They have a power grid to build. If the price of silver drops, do they stop buying? No. They buy more. They thank the bankers for the discount, and they drain the physical supply even faster. This is what we call inelastic demand. When the price of a luxury good like a designer handbag goes up, people buy less of it. That is elastic. But silver is not a handbag. Silver is the gasoline of the 21st century economy. If the price of gasoline goes up, you still have to drive to work. You pay the price. And if the price of gasoline crashes, you do not stop driving. You fill up every jerry can you can find. That is exactly what the industrial giants are doing right now during this holiday sale. Elon Musk and the electric vehicle industry are not looking at the chart and panicking. They are looking at the chart and laughing. They are securing long-term contracts directly with the miners, bypassing the COMEX entirely, because they know that without silver, their cars do not run, their batteries do not charge, their AI servers do not compute. And let us not forget the darker side of demand. The military-industrial complex. We are living in a geopolitical powder keg. Missiles, fighter jets, drones, satellites, all of these require massive amounts of high-grade silver for their guidance systems and circuitry. Do you think the Pentagon or the Ministry of Defense cares about a 10% drop in the paper price? Do you think they are going to delay a missile program because a bot on Wall Street painted a red candle on a chart? No. They're going to consume metal. And unlike the gold in a vault, which can be melted down and resold, the silver in a Tomahawk missile is gone forever. It explodes. It is consumed, it is deleted from the global inventory permanently. So, we have a situation where the supply is being destroyed by industry and war, while the paper price is being destroyed by speculation. This disconnect cannot last. It is a mathematical impossibility. The bankers know this. Why do you think Wells Fargo raised their target for gold to over $6,000? Because they know the fiat currency is failing. They know that when the dollar loses its purchasing power, the only things that will hold value are the things you cannot print. They are telling you to look at the $75 price tag and feel fear. But behind closed doors, they are looking at the same price tag and seeing an opportunity of a lifetime. They are banking on you not understanding the difference between price and value. Price is what you pay. Value is what you get. Right now, you are paying $75 for an asset that is statistically disappearing from the face of the earth. The thrifting argument, the idea that industries will use less silver as the price goes up, is dead. We have reached the physical limit of how little silver we can use in a solar panel or a microchip without sacrificing performance. We cannot thrift anymore. We have to use the metal. So, when you see that red candle, do not see it as a loss of wealth, see it as a subsidy. The paper speculators are subsidizing the industrial consumption of the West. They are keeping the price artificially low, which allows Tesla and Samsung and Lockheed Martin to buy the metal they need at a bargain. But eventually, the physical shortage will break the paper pricing mechanism. When a factory calls the COMEX and asks for delivery of 5,000 bars, and the COMEX has to say, sorry, we only have paper certificates, that is when the game ends. That is when the price resets to reality. And judging by the speed at which the vaults are emptying, that day is coming much faster than the algorithms predict. So, here is the game plan for the rest of this crazy week. We have established that the price on your screen is currently being driven by a bunch of unsupervised algorithms that are having a temper tantrum because their parents, the physical buyers in Shanghai, are on vacation. You have two choices. Choice number one is to panic. You can stare at the red candles, let your blood pressure spike, and sell your hard-earned silver to a machine that will instantly flip it for a profit the moment the sun rises in Beijing next week. That is exactly what they want you to do.